This video will cover the broad reasons why financial intermediaries are regulated and how the regulatory framework operates in the United States. Because financial intermediaries, and especially large banks, have access to significant government protection, they're also subject to regulation and supervision, as the depositors and investors have little incentive to monitor intermediaries' investment decisions otherwise. In the second half of the 20th century, deposit insurance, for instance, has expanded in many countries. However, the incidence of banking failure only reliably declines where tight regulatory rules and supervision have expanded as well. The regulatory rules governing who can open a bank and what banks can do. These significantly vary from country to country, and here we're only going to focus on the US in the interest of time. In the United States, regulators screen whoever wishes to open a bank carefully through a charter granting process. Applicants need to bring in a detailed business plan, including demand, for instance, for financial services in a certain geographic area, earning projections, and so forth. They need to bring in a large amount of startup capital, and they need to have experienced management with relevant expertise. Further, applicants with conflicts of interest are typically denied a charter. As one example, Walmart several years ago tried to offer financial services at its branches, which was blocked by regulators. Who regulates a bank depends on the scale. Nationally chartered banks are regulated by the OCC, the Office of the Control of the Currency, which is part of the Treasury Department. State chartered banks receive their charters from state regulators, and both the Fed and the FDIC have additional regulatory functions. Finally, specialized intermediaries like mutual savings bonds or currency unions have their own regulators, so do different types of intermediaries like insurance corporations. For historical reasons, you should be aware that prior to the end of the 1990s, restrictions on bank structure were governed by the so-called Glass-Steagall Act of 1933, which was passed after the early banking crashes of the Great Depression, and through the amendments made by the Bank Holding Company Act of 1956. One important rule was that commercial banks were not allowed to participate in investment bank activities such as securities underwriting if they were also issuing deposits at the same time. Buckling to pressure from lobbying and competition from money market mutual funds, the separation of investment and depository institutions was abandoned by the Gramm-Leach-Bliley Act of 1999 under the Clinton administration. However, after the mortgage crisis had spilled into the commercial banking sector during the financial crisis in 2008, the Dodd-Frank Act once more established significant banking regulation rules. It did, however, not re-establish the separation of depository and investment banks because the lines are very blurred today, instead opting for a push towards transparency and lending guidance. Aside from opening a bank, there are extremely detailed restrictions on business practices once a charter has been granted. Supervisors and regulators are in ongoing conversation with banks who have stricter disclosure requirements than regular firms and have to report to the regulators on a more or less ongoing basis. Broadly, non-lawful, discriminatory, or risky practices are generally regulated. Simplified regulations focus on two broad categories. We're not going to go too much into details because you can fill big books about banking regulations. The first one are sweeping restrictions on bank assets, and the second are so-called capital requirements. Starting with the first, much detailed regulation surrounds what kind of assets banks can and can't hold. For instance, banks are not allowed to hold common stock or risky fixed income assets, although there are some exceptions, for instance, when banks trade against their own equity in so-called firewalled proprietary trading desks. This practice is not uncontroversial as it can erode bank capital, but it has been very profitable, especially in the 2000s for firms like Goldman Sachs. Asset regulation has limits, since financial innovation tends to find ways of circumventing the rules. Securitization, for instance, allowed banks to take on risks that they otherwise wouldn't be allowed to have in the pretext of the financial crisis of 2008. Once the market turned in 2007, all of a sudden dramatic write-offs appeared on the balance sheet of banks. In general, regulation is often reactive. This is true not only for banking, but for most industries. And the regulators really tend to be one step behind the bankers in this case, or behind whoever they are regulating. As a consequence of that, and in the interest of international harmonization, much discussion in banking regulation circles around the issue of capital requirements. A common and ubiquitous measure of banking regulations and capital restrictions is the so-called equity ratio, what you see here. Next slide. Equity generally acts as a buffer against insolvency when assets lose value. Let me give you an example of what I mean by this. Keep in mind that equity are the funds that banks bring in. So this is an example bank. This bank has about 10 million in cash. It has 40 million in loans. It has 40 million in securities. It has 70 million deposits. 20 million are equity funds that the bank's owners bring in. Now, say for whatever reason, 30 million of the bank's assets lose their value. There's some sort of event, credit event, bad economy that leads to a deterioration in loan values. In this case, the bank needs to write it off against its equity. Its liabilities do not change. The bank still owes you on your deposits any bit as it did before. The problem here is that equity of this bank is only 20 million, which means that if it has to write off 30 million of its loans, the bank will become insolvent. If the bank held a larger amount of equity, say for instance 40 million, it would remain solvent. So equity is an important buffer in general against insolvency. Now, as it further turns out, complicating matters, banks have an incentive to economize on their capital holdings since they can increase their profit margin by taking on debt. This is known as leveraging. It's one of the many meanings of the word leveraging. When we talk about leveraging in finance, it means taking on more debt. One common way to measure leverage in a financial statement is a financial statement statistic known as the equity or capital ratio, and that is simply the value of a bank's equity over the value of its assets. So what is the value of the funds that the owners bring in over the value of all the assets a bank holds? A higher equity ratio indicates less leverage. There are variations like the leverage ratio or ratios broken down by the risk quality of assets. And as it turns out, these ratios play a critical role in bank stress testing and regulatory exercises. Related to leverage are bank profit margins. For instance, the return on equity, or ROE, indicates the profits shareholders make for each dollar of equity on the books. It's simply profits divided by the value of equity. As a technical note, notice that this is different from the market price of stocks. It's simply what's on the books. Generally speaking, however, the higher the ROE, the more profit falls back to the average shareholder. Now, return on equity, as it turns out, is directly related to the equity ratio. If you're dividing both the numerator and the denominator of the ROE by the value of assets, we can express ROE as return on assets. That is simply profits divided by the value of assets. It's the profit for each dollar of assets that a bank holds, divided by the equity ratio. Now, the higher the equity ratio then for a given return on assets, the lower the return on equity. Intuitively, by leveraging, banks can increase the return on profits for a smaller ownership base. So the idea is you have the same profits, but you have fewer owners. That means every owner on average makes more. We'll provide a numerical example in a practice problem for this video. It's not particularly complicated. It's just something you have to work through a couple of times. Higher debt is also associated with moral hazard. So leveraging is a problem because it can shift incentives for banks. Borrowed funds are not the bank's own, which limits downside risk for the owners, especially in the case of publicly listed firms with limited liability. If a bank realizes sufficient losses, debtors and other external stakeholders will lose funds, while the shareholders simply end up at zero. A big part of the Dodd-Frank Act and its implementation by the Federal Reserve are annual regular bank stress tests, and specifically the annual Comprehensive Capital Adequacy Review. Mouthful really. It's referred to as CCAR typically. In these exercises, banks in detailed manner have to illustrate how their assets, liabilities, and incomes would be affected by some hypothetical adverse economic shock. One core aspect of the exercise is to keep leverage contained. Do banks have enough equity to meet the downturn? In a similar vein, the International Basel Accord, ratified by over 100 countries since the 1980s, sets similar guidelines across countries internationally, and among other regulatory efforts seeks to establish harmonized capital standards across countries. These efforts are spearheaded by the Bank for International Settlements, which if you ever need to look up data on banking is a great resource. Capital requirements have the upside of being simpler compared to specific asset regulations, as they force banks and other intermediaries to have some skin in the game. Stress tests have further acted as monitoring tools for credit activities since the crisis, and regulators like the Fed have sometimes issued guidance when banks expanded risky segments like auto loans in the mid-2010s and more recently credit cards. While many in politics and public discussion are still scarred from the 2008 world, although COVID might change it a little bit, the business models in banking really have adjusted away from the leverage excesses of the 2000s, at least for now. The graph in front of you indicates the equity ratio for US banks since the Great Recession. And you can see that after 10 years of regulatory exercises and stress tests, the US banks are about as well capitalized as they last were in the 1970s. This is one of the reasons why commercial banks had little initial issues during the COVID lockdown era with problems like forbearance and loan deferment. They simply have a much larger buffer than they did 10 years ago, and they simply have much better risk exposures. Even critical segments like commercial real estate, which will arguably struggle for a while, are simply not enough to trip up financial intermediation in the same way it did more than 10 years ago. Finally, other intermediaries have their own oversight rules and regulators. Some are laxer, some are tighter. Policy tends to focus on larger investors simply because of their macroeconomic relevance.